Good afternoon, sir. Good afternoon.
Good afternoon.
Sorry, sir. Good afternoon, sir.
All right. No problem. Can you all hear me fine?
Yes, sir.
Yeah, sir.
Yes, sir.
Yeah, you
Great.
are audible, sir.
Yeah.
Just let's start. Riyaz sir will start.
Sure. I
So-
believe, yeah. Hi, everyone. This is Riyaz from Bombay. I believe Gurpreet has already given you my introduction, so I won't duplicate that. Basically, we'll start with my topic is mutual funds. I'll be covering what are mutual funds, what are the benefits, and what are the regulatory regulations for mutual funds, and what are the different types of mutual funds. So, uh, I believe in a two-way interaction rather than a one-way. So, can anyone tell me what is your understanding of mutual funds? You can unmute and tell me. That's fine. Okay. Yeah. So I'll
काही माहित
continue.
नाही ग तेवढीसाठी काय आहे ग? काय की नाही?
Sorry, go ahead. Okay. So mutual funds are basically an investment vehicle. And what do you mean by an investment vehicle? An investment vehicle is kind of a structured product by which you can invest in securities. You put in the money and you get a returns from it. And what mutual like normally you buy a security, the money goes from your bank account, and the share or the security goes into your demat account when you purchase it. And then the price goes down, you lose money on that. And if it goes up, you make a good profit. Whereas in mutual fund, it is an investment vehicle that pulls money from multiple investors. So to understand that perspective, it's like say you're staying in an apartment building in a cooperative housing society, and there are 50 members, 50 flats. Now we all want to invest in the share market. So each member of the flat, each member or each flat owner contributes 1,000 rupees every month. So 50 flats, so you get 50,000 rupees every month, or about 6 lakhs rupees a year. And then you decide to invest in the equity markets. Now all the members of the flat, they are working, they don't have time for researching the markets and finding out which shares to buy of which companies and all that. So you appoint a fund manager who takes care of all the nitty-gritty for you. So this in a nutshell is a very simplistic definition of a mutual fund. So only difference is that it takes money from multiple investors, like maybe a few thousand or lakhs, and purchase a diversified portfolio of stocks or bonds or other securities. By bonds, I mean corporate bonds or government securities, government bonds, corporate paper, and so on. And this allows you and me, like the retail investor, access to a broader range of assets than would be possible individually. Like, I believe there's one company, MRF Tires, if I'm not mistaken, which is quoting around 80,000 or 1 lakh rupees a share when I last checked. Now, for us, I mean, maybe we can buy at the most one share or two shares. Whereas mutual funds, with their large amount of corpus available to them, they can easily buy 100 of these shares or 1,000 and get the benefit of the price movement. Right? And it's also this diversification helps to reduce the risk by mitigating the poor performance of any one single asset. So, like mutual funds, they don't just invest in a single security, they invest in multiple securities. Like in any mutual fund, you'll have investments of Reliance, for example, Tata Iron and Steel, uh, say Godrej, HDFC Bank, Kotak Bank. I mean, some will have 10 scripts, some will have 20 scripts, some will have 30 scripts, depending on their charter. So if any of these go down, okay, the fund loses little money, but the other scripts go up and make up for it, right? Because all the scripts not move in the same direction. Like in any, like farmer scripts are called fair weather friends, Because even in the recession, people are going to buy medicines. People fall sick, whether the market is booming or market is in a recession. So you can make a profit on that. And therefore a balanced approach to asset allocation. Now we come to the types of mutual funds. Mutual funds are categorized into several types in India. Like you have the equity funds, which is more of a self-explanatory. They primarily invest in stocks, the primary issues or the secondary issues of companies. Anyone knows what is the difference between primary and secondary? Primary market and secondary market. So a primary market is for an IPO. When an sorry,
IPO.
yeah, IPO, initial public offer. So when a new company comes into the market and raises money from the investors, it is called an IPO. And they release the shares to the investors who have applied for it. So not everyone gets it. Some people get it, some don't. And the secondary market is where we do daily buying and selling of the equities. So this is when mutual funds do. And the risk level is higher in equity funds, making them suitable for investors who have a longer term perspective, like say you are planning on investing your money for 5 years or 10 years or 3 years for that matter. Then again in equity funds, which is one category of mutual funds, they are further classified based on the size of companies they invest in. So is anyone familiar with the different categories of companies, like based on their market capitalization? What is market capitalization? So market capitalization is basically of a company is all the outstanding shares of the company multiplied by their current share price. So for say a company XYZ, which has been trading in the market for 2-3 years from now on, 2-3 years in the past, say they have 100,000 shares outstanding. So if tomorrow you want to buy all the shares of the company, you'll be able to buy 100,000 shares maximum, not more than that. And each share price is 50 rupees, for example. So the market capitalization is 50 into 100,000, that's 50, 100,000 or 50 lakh rupees, right? So now equity funds are classified into large cap, mid cap, or small cap. So large cap is above a certain number of market cap. Maybe I think I don't know the exact numbers, but it could be about 100 crores plus. Then I think 20 crores or less is a small cap, and 20 to 100 crores would be a mid cap company. Now, you'll ask me that what is the rationale behind this small cap, mid cap, and large cap? Now, small cap companies are companies which are just come to the market, or they have not been doing well, or there is a lot of potential for growth of these companies. And on the same side, there is also a potential for their stock price to come down to zero, towards zero, not necessarily zero. So these small cap companies, they're very volatile, and the advantage is you can also get good returns from them. Then mid cap are those companies which have been around for some time and they're doing good, but they don't have that larger base of investors or shareholders. And then you have the large cap companies like Reliance Industries, for example, or Tata Iron Steel, which have a very large pool of investors. Then equity funds also target invest in different sectors like pharma sectors, as pharmaceutical companies, banking sector, automobile sectors, and so on, to diversify their risks. So after equity funds, you have debt funds. So what are debt funds? Debt funds are those which focus on investments in bonds, government securities, corporate debentures, and other debt instruments like commercial paper, for example. So what are all these debt instruments? These are debt instruments are like a bond you purchase from a company and the company pays you interest. Or you buy from the government and the government gives you interest at periodic intervals of time. And the advantage of debt funds is they offer lower risk compared to equity funds. Naturally, we all know the equity market is very volatile, whereas a debt fund, if you buy from the government, they're more or less volatile. And the major movement is because of interest rates or expectations of interest rates. We all know the relationship between interest rates and bond prices. If interest rates go up, the bond prices come down. If interest rates fall, the bond prices go up. So these funds invest in the debt funds to get a stable income, which is their interest payments. And they're preferred by individuals who are looking for preservation of their capital and a regular income, which is the interest payments. Then we come to hybrid funds. Can anyone take a guess and tell me what is a hybrid fund? I mean, we had spoken about equity and debt funds. What is a hybrid fund?
Mix equity and debt fund.
That's right. So they combine the characteristics of both equity and debt funds. Equity is very volatile and debt funds are very less volatile. And the advantage is it allows you to balance the risk reward ratio. In finance, the basic rule of finance is high risk, you get a high return, low risk, you get a low return. So you want to work out a compromise between the two, where your risk is manageable and your return is also balanced. I mean, not very high, but not very low either. So then you have in the hybrid funds, you have like the balanced fund, where your typical division is 60% equity and 40% debt. Then you must have also heard of monthly income plans in mutual funds that invest in debt instruments with a small equity component. And why is it called a monthly income plan? Because the debt instruments give out periodic interest payments at regular intervals of time. Some may be semi-annual, some may be annual, some may be quarterly, for example. We come to the fourth type of mutual fund, which is a solution-oriented fund. Has anyone heard of these funds? What is a solution-oriented fund? You can unmute yourself and share it as your answer. Solution-oriented.
Gold ETF.
Sorry.
Gold ETF.
Yes, gold ETF. Now I've not called it that. That is a kind of a mutual fund, but a solution-oriented fund is more for a specific investment goal. Like for example, a person who wants to retire for retirement planning, you need a X
Yes,
amount
sir.
of rupees 30 years from now or 20 years from now, depending on your age and where you are in your working career. So you invest in these funds, and many of these funds have a lock-in period. A lock-in period means, say, a lock-in period
5
of
years.
3 years or 5 years. If it's a 3 years, means you purchase the fund and you cannot sell it back for another 3 years. You're stuck with it. If it's a 5 years, you're stuck with it for 5 years. Or if for your children's education, say you got a couple of kids and they're 2 and 3 years old, and you know that when they turn 16 years or 18 years, they'll require funds for their university and higher education. So you can invest in the mutual funds now and keep on investing in a systematic investment plan, for example. And after 15 years or 18 years, you'll get a good amount of money, which can be used to fund their education. There can also be other reasons like a marriage, for example. Then you have the fifth one is the index funds. Index funds, the very name itself implies they duplicate the performance of a specific index, such as a Nifty index fund. Now we all know about the Nifty and the Sensex. The BSE Sensex has about 30 shares in it. Nifty has around 50 shares in it in various proportions, various weightages. So, say you want to track the Nifty and you want to buy the shares of the Nifty. We all know what is the Nifty level currently. It was nearing 25,000 and now it is back down to 24,200, 24,300. Of course, a few years back, the Nifty was at 15,000 or 16,000. Now, some of us were fortunate enough to buy shares which have also significantly appreciated in value. But what if we had purchased a Nifty index fund at 15,000? You'll have made a windfall in this interim period. So the Nifty index fund, for example, invests in the same stocks that constitute the Nifty index in the same proportions. And they are known for their passive management strategy because all they have to do is manage the weights of the funds in the index fund. Like for example, they'll have like Reliance, HDFC Bank, Kotak Mahindra, and another 47 other shares which constitute the index. And how the index changes is every day the weights of the stocks in the index are computed based on their market capitalization. So accordingly, these weights change. So all the index fund has to do is manage the weights, maybe buy a few shares, sell a few shares. And they also have a lower expense ratio. So each type of these mutual funds that we have discussed, like equity funds, debt funds, hybrid, solution oriented, and index funds, they serve a different purpose and align to your investment strategy based on your risk appetite, your investment horizon, and your financial goal. So by offering all these options, mutual funds in India make it possible for anyone to participate in the financial markets and enjoy a potentially high return, and also at the same time diversify your risk. So now we come to what are the benefits of investing in mutual funds. If anyone wants to share of another type of mutual fund which you have not covered, you can share it now. Like for example, someone mentioned about a gold ETF. That's a gold exchange traded fund. And that is not a mutual fund because it is only investing in gold. It's like you're buying a shares of Reliance, or you're buying silver, or you're buying gold. So that is your gold ETF. If gold price goes up, your fund value goes up. If gold price goes down, the value of your fund decreases. So there is no diversification of risk in that. Now the benefit of investing in mutual fund is there are many benefits. One is diversification. So like they invest in multiple securities, maybe 10, 20, or 30. So some funds may be investing in five different, how do you say it, sectors like automotive, pharmaceutical, banking, IT sector, for example. Now, tomorrow if the rupee strengthens against the dollar, for example, which sector will be affected badly? Rough guess. The dollar becomes strong and the Indian rupee becomes stronger again. Sorry, the dollar becomes weak and the Indian rupee becomes stronger against the dollar. So if a rupee becomes stronger against the dollar, your export proceeds will become less. Am I right? You get less rupees for the dollars. So all the IT companies which are in the IT sector will be affected because majority of their revenue is export driven. So they will be affected. So the mutual funds, when you invest in different sectors, you invest in IT as well as you invest in pharma sectors. So pharma sectors will do well, IT may be down. So you compensate for the fall in one sector by investing in another sector. Then professional management. Mutual funds are managed by experienced fund managers who have expertise to analyze the market trends and the company data. And they also have to assist them a full team of research analysts, equity research analysts who concentrate on the various sectors. So for each of us individually, maximum we can analyze maybe 5 or 10 companies based on the time we have at our disposal. Whereas for these professionals, analyzing 50 or 100 companies is a day's work for them with the teams they have in place. Any questions so far? So we're talking about the benefits of investing in mutual funds. Another benefit is affordability. Now, normally you buy shares of companies like Reliance Engineering 3,000, and some companies are at 10,000, like Maruti is at 12,000, for example. It's a large amount to invest in for you and me. Maybe most we may be able to buy 1 or 2 shares. But mutual funds, you can, through buying a mutual fund, you can have an exposure to the shares of these big companies, for example. And not only that, you can also start with relatively small amounts of money and get access to a diversified portfolio of stocks and bonds, which would be otherwise quite expensive if you do it individually. Like, for example, what do you think is the minimum investment size for mutual funds? I mean, I'm sure some of you all will have
100 rupees?
100 rupees. Yes,
500.
the 100 rupees also is right. In fact, I used to think it was 100 rupees, but then I have this Paytm thing, and that I was looking at one of their menus, and I believe now it is 21 rupees I can invest in on a daily basis. So that shows you how affordable a mutual fund investment is. And liquidity. Mutual funds also offer a high liquidity among the asset classes, where you can buy a mutual fund today, and after 3 days you want to square it off, you can sell it and get the money back at the same time. Unless, of course, your funds are in a lock-in, which is of 3 years or 5 years. Other asset classes like real estate, for example, liquidity is a concern. Then flexibility. Mutual funds also offer various plans like SIPs, systematic investment plans. Everyone familiar with what are SIPs? A systematic investment plan is like, say you got 1 lakh rupees to invest in the share market, or you want to invest in mutual funds. And instead of buying today, you don't know the market is poised at 22,000 something. You don't know whether we are going to look at 25,000 or we are going to see 15,000 1 year from now or 2 years from now. So what you do is you go in for a systematic investment plan whereby you invest 2,000 rupees every month or 1,000 rupees a month for the next 2 years or 3 years. And anytime you get a regular feedback from the mutual fund, what is the value of your investment? So if you feel you have reached your goal, you can square it off. So this is the flexibility. Then along with SIPs, they also have systematic withdrawal plans. Like say you invest a bulk sum like 5 lakhs in a mutual fund, and then you want to get some, you said I want to get a regular income from it. So some mutual funds offer a regular income, but for that the return is less if it is mainly a debt fund. Or if it's an equity fund and is doing well, you have the systematic withdrawal plans whereby you can withdraw 10,000 or 15,000 or 20,000 rupees every month for the next 5 years. provided you have a sufficient amount of capital locked in the mutual fund. Then you have the dividend reinvestment plans. Like mutual funds invest in shares, shares give dividends, which is an income for you, the investor. So you can choose and instead of getting a dividend in your bank account, the mutual fund will reinvest it to buy the shares of the mutual fund or the units of the mutual fund. Then transparency. You go to any mutual fund's website, you will know immediately which are the shares of the companies they are investing in, their funds performance, past 2 years, 5 years, how they performed since they're starting, what are the charges, who are their fund managers. You also hear in the news when the particular fund manager leaves. So you can take appropriate call for your investment in the mutual fund. Then we come to tax efficiency. So you have these ELSS, equity linked savings schemes, which are mutual fund schemes whereby you get tax benefits under various sections of the Income Tax Act. So your returns are tax free, or you can save on tax. Then of course there's economies of scale as we have discussed. And of course the main thing is regulatory oversight. Mutual funds in India are well regulated by the Securities and Exchange Board of India, which ensures fairness and transparency for investors. Now we look at any questions so far on the benefits of mutual funds. So now we look at how mutual funds work.
So, I
Yeah.
have some one question.
Sure, go ahead.
Sir, in this budget, there long term have 12.5% tax
All right. On capital gains.
on capital gains. So now, sir, you say this mutual fund is tax free.
No, not all mutual funds. You have some
Okay.
mutual funds which offer you this ELSS, equity linked savings schemes, whereby you can get the tax benefit on by investing in them.
Thank you, sir.
Not all, yeah. But then again, you have to also look at the returns you're going to get pre-tax and those funds whereby after paying tax also the returns may be higher than going for a fund whereby you get a tax benefit. So it's all a big mosaic, and you have to make an appropriate call on that. Yeah. So how do mutual funds work? Now, say a company decides that we want to set up a mutual fund. They are the sponsor, like Aditya Birla, for example. So they will set up a trustee, and then a trustee will set up a asset management company. All these are regulated by the Securities and Exchange Board of India, SEBI. And asset management company is the one which will actually do the daily nitty-gritty of buying and selling the shares in the mutual fund. And you buy the units from the asset management company. And the shares they buy, they are kept with the custodian, who is the holder of the how do you say actual shares, and keeps track of the dividends to be paid out. Now, in mutual funds working, you have the main term is a net asset value. So, what is the net asset value? It is the per share value of the mutual fund, and it is calculated by dividing the total value of all the securities in your portfolio less any liabilities divided by the number of fund shares outstanding. So the total value of a shares is 1 lakh rupees and number of fund shares outstanding is 1000 shares, 1000 units which have been sold to the public. So 1 lakh divided by 1000, that's 100 rupees is your net asset value of the mutual fund. And this changes every day based on the market values of the fund's holdings. And is also the price at which investors like you and me can buy the mutual funds shares and sell them back to the mutual fund. Then we look at the role of the asset management companies. The asset management companies, or AMCs as they are, they manage the mutual funds and they make the investment decisions on what to buy and when to sell. And they have the fund managers who analyze the market trends and the economic data. So what is the buying process for a mutual fund? We purchase shares directly from the fund or through brokers at the current net asset value, plus any possible sales charge or load. Or if you go in for a systematic investment plan, you can buy shares over a period of time. And the buying process is called investment. Selling process is called redemption, which means you can sell your shares back to the mutual fund at the current net asset value, NAV value. Then distribution. If the fund achieves profits from its investments, it distributes these profits to the shareholders in the form of dividends. Now we know that what are the different how it works, and the mutual fund in India has seen a substantial growth over the past few years, and a number of factors have been responsible for this expansion. Can you tell me some of the factors that can be responsible for this growth in the mutual funds? What do you think? The main factor is the systematic investment plan, SIPs, because they have democratized the access to the mutual funds. Earlier, it used to be like you need 1,000 rupee investment, or some funds require 10,000 rupees minimum investment by the units of the mutual fund. Whereas with SIPs, like the one I have got, I'm paying 21 rupees a day for investing in a mutual fund. And you can also spend 500 rupees a day based on your capacity. So it allows a broader range of income groups to participate in the market. Another major factor responsible is COVID. Because in COVID, we know what happened. There was a lockdown. So many people felt that the share market was functioning normally at that time. And people, a large number of people, I believe, opened the demat accounts. That means they began trading. And the first thing they'll do is buy securities naturally before selling it. So that has led to the upsurge in the mutual fund industry. Then secondly is the regulatory enhancements by SEBI, Securities and Exchange Board of India, which has served to improve transparency and trust in mutual funds. We all have heard of the different scams that have happened in the past 20, 30 odd years. So these regulatory enhancements were very much required, and they include the tightening of the norms around the expense ratios, improving the disclosure requirements, and we'll be covering these in more detail. There are different investor-friendly measures such as categorization and rationalization of mutual fund schemes. And the industry's growth is also influenced by macroeconomic factors like stable economic growth, rising disposable incomes, and evolving investment habits. So we're looking forward, the mutual fund industry is expected to continue its growth momentum due to various technological advancements like robo-advisory services, increased digital penetration in the rural areas, and improved regulatory support. Now, how has the regulatory support helped to improve the mutual funds perception in the eyes of the investors? So the key regulations were like the SEBI mutual fund regulations 1996. These outlined the framework for the registration, operation, and management of mutual funds in India. The one they did was the structure of mutual funds. So they said that the mutual funds must be structured as trusts under the Indian Trust Act 1882, where you have a sponsor, a trustee, an asset management company, and a custodian. A sponsor is the one who initiates the process for starting a mutual fund. A trustee is the one who does oversight that everything is going properly as per the regulations. Then the asset management company, which does the daily nitty-gritty of investing and buying and selling and dealing with the investors, and the custodian who takes care of the securities. Then the other regulation of 1996 dealt with operations of mutual funds. It stated that all mutual funds are required to register with SEBI and are subject to periodic inspection or auditing. They must adhere to strict investment restrictions, which will include limits on investments in unlisted securities, specific sectors, and group companies. For example, in a particular group, not more than 25% of the assets of a mutual fund can be invested in a particular group. Like, for example, XYZ mutual fund, they cannot invest more than 25% in Reliance Group, for example. And for, say, Reliance Industries by itself, maybe 5% of their corpus can be invested in Reliance Industries or any one company as such. And they also specify the SEBI regulations specify the formulation of schemes which must be approved by the trustee and by SEBI before they are offered to the public. And secondly, all mutual funds are obligated to send quarterly reports to their investors. Next, SEBI has also given out on investor rights and services. Transparency and disclosure norms are rigorously enforced, which I have discussed earlier, that the funds are required to disclose information about the performance, financials, investments, and risks. Then the funds are required to dispatch the unit certificates to investors within 6 weeks of their investments and disclose their NAVs periodically. And must also ensure redemption within 10 working days from the date of redemption request. Then there have been a lot of news in the media about misleading advertisements. So SEBI has also regulated the content and format of the mutual fund advertisements to ensure that information is presented without misleading investors. So this is by having proper documentation and a prohibition against guaranteed returns unless certain conditions are met. So this condition will be mainly what kind of securities they are investing. And SEBI is also empowered to impose penalties on mutual funds, their trustees, or the other parties involved for violation of the stipulated regulations. And in severe cases, SEBI can bar these entities from accessing the securities market and can even dissolve the mutual fund if it feels the need to do so. Then another major regulatory factor was the categorization and rationalization of mutual funds, which was implemented in 2017. So this reform standardized mutual fund categories into 5 main types, which we already discussed: equity, debt, solution-oriented, hybrid, and other schemes, with specific subcategories like you have based on market capitalization and investment strategy. So you have heard of these small cap, mid cap, large cap, multi cap. Multi caps means both in small cap and mid cap. And fund managers have to align their strategy strictly with the new categorization and ensure that there is a clear communication and understanding for investors. Also, the other thing is SEBI has imposed regulations to cap the total expense ratio for mutual funds. What is the total expense ratio? These are the fees that funds charge because funds take your money, they invest in the markets, and they sell it off and they make a profit or a loss. Now, how do the funds benefit in this? So they charge you fees for their management, administration, and other operating costs. So they have SEBI has put a limit on them. That what is the total expense ratio? Means percentage of the total assets under management. Maybe 0.5% or 1% or something like that. So which limits are designed to protect investors by ensuring that more of the capital is invested rather than spent on fees. So you get better returns. And these, what do you call it, total expense ratio fees will be communicated to investors. And as I said, this 0.5 to 2% can vary by fund size and type. And SEBI has also established a comprehensive risk management framework to ensure the stability and integrity of the mutual fund industry. So in that you have in the risk management framework, you have risk identification. So they have to identify, mutual funds have to identify potential risks with their investment strategy. So what can be the potential risks for a mutual fund in their investment strategy? Any takers? Anyone? I mean, the most obvious is market risk. You invest in a security, you are exposed to the market risk. You buy something at 100, if price goes to 120, it's good for you. If the price goes to 80 or 60 rupees, that's a market risk. Then you have the liquidity risk. You invest in a company which goes under, for example, and if you're going to find buyers when you want to square off your investments. And operational risk. Operational risk means you have employees who mismanage the funds, for example. So that has to be taken care of by having a proper regulatory oversight. And once these risks are identified, they need to be quantitatively and qualitatively assessed. So they use various statistical measures like VAR, value at risk, stress testing, and scenario analysis to measure the potential impact of risk on their portfolios. Like the funds are invested in, say, 20 companies, and the next one event happens, like COVID, for example, or a 9/11, and how did it impact the shares of the companies? So did they have adequate hedging mechanisms in place? We all know what is hedging. Hedging is an activity you undertake to prevent a loss from a adverse event happening. So, for example, hedging means, say you are investing in a gold manufacturing company, right? So as long as the price of gold goes up, you're making good. The share price will go up, and the company will make a profit, and the mutual fund will make a profit, which is invested in that company. But what happens if the price of gold goes down for whatever reason? Automatically, the price of the gold manufacturing company will decrease in value, and the mutual fund which has invested in that company will take a hit. So, depending on the size of the exposure to this gold manufacturing company, they need to hedge it. And the easiest way to hedge it is by selling gold futures. So gold goes down, your gold futures which you have sold, they make money. So you overcome your risk. So your profits in the hedging balances the loss in the, how do you say, in the actual operations. Then you have risk limits. So based on the risk assessment, mutual funds have to set risk limits for different types of risks. Like for example, in a particular sector, how much can you invest? So they have different limits, like maybe 10% or 15% of your funds in one sector in IT, 15% in automobile, 15% in the pharma sector, and again 5% in any one company. So you don't over leverage. You're not exposed to, if one company goes under, the fund as a whole doesn't take a very big hit. Then, of course, with all these risk limits and everything in place, monitoring of the risks is very important and compulsory. Then also the SEBI has set various regulatory limits for mutual funds, such as limits on exposure to unlisted securities, and what we have discussed. Then they also must have liquidity risk management, which includes stress testing under various scenarios, so to ensure they can meet the redemption requests. It shouldn't be a case that investors, the market goes down, some investors will be panicky and sell their units and they want their money back. So the mutual funds should have enough cash on hand to meet their investors' needs or make arrangements for that. The SEBI's plans were direct plans for mutual funds were introduced in 2013. I think we are running out of time. Gurpreet?
Yes, sir. No, sir. There's no issue.
No.
You can go ahead.
Okay. So the direct plans for mutual funds were introduced, by which investors get an option to invest directly in mutual funds without the involvement of distributors or agents. So normally you invest in a mutual fund, you go through a broker, or in this case a distributor, a mutual fund distributor or a mutual fund agent, and naturally the agent will get some commission from it, which goes out of your pocket. So your cost of buying a mutual fund goes up the marginally. So SEBI has done away with that. As said, there's also one option if you want to, if it is possible for you to go directly to their website, for example, and directly buy the mutual fund. The advantage is this will lower your expense ratios to initiate a position in the mutual funds and lower your and increase your returns, basically. And the direct plans have lower costs, so the net asset value tends to be higher than those of the regular plans. And these direct plans are ideal for savvy investors who understand mutual funds and can manage their own investment schemes. And under the new scheme, under SEBI's regulations, all mutual funds are required to offer a direct plan for every scheme they manage. And these plans are distinct from the regular plans. And at the time of investment, the investor should explicitly decide. Then SEBI has also put forward investor redressal mechanisms, like they have established SCORES, which is an online platform that allows investors to lodge complaints directly with SEBI against listed company and intermediaries like mutual funds. They have an arbitration and mediation mechanism. They also have their investor education programs, like for example, the SEBI investor education program increase the financial literacy among the public. The SEBI offers online courses and interactive modules and so on. So this is a nutshell of what we wanted to discuss about mutual funds. Now I'm open to any questions you may have.
Sir, can you please explain some job roles and key feature in asset management company?
Yeah. Now, if you go to asset management companies, what they do is they initiate the trades. So the main job role can be of equity research analyst to research the companies. Then also there will be support roles like a new client comes on board, you invest your money, so onboarding of your client. So there'll be the KYC process. So need someone for that. Or if you want to redemption of the funds, someone to take care of the administrative work. So that can be a role in the asset management company.
Okay, sir.
Any other questions?
Is there any best strategy of hedging?
Uh, there is no best strategy. Basically, it is hedging is basically the whole idea of hedging is not to make a profit, but it is to mitigate your risk. That if you're losing money in your physical trades, you make money in your hedging to offset the loss. So basically, it's a more of a loss prevention strategy rather than a profit making strategy. And the best strategy, of course, will be that you do 100% to safeguard against the adverse event happening. Like, for example, Reliance shares you have bought and you expect the price to go towards 4,000, and instead you see the price going towards 2,000. So you hedge against it by buying Reliance Industries put options, for example. I'm sure some of you are aware about put options. It's a kind of a
Yes, sir.
derivative which gains in value if the price of the underlying security goes down. So now you got, say you got 500 shares of Reliance and your put option lot is also 500. So naturally, if Reliance goes down, you'll make 100% or 60% profit depending on the strike price, how far it is from your current spot levels. So the best strategy of hedging will be that you have to do dynamic hedging. Don't fix a particular amount because then your cost will go up for hedging. Whereas you start with a small amount of hedging and increase it as the adverse event happens. And if it doesn't happen, your cost of hedging is minimal. Any other questions?
Anyone have any questions you can ask regarding a mutual fund to sir directly? किसी को कोई क्वेश्चन नहीं है? अजीत, दीक्षा,
Sir, can we
Durgadas,
generate a
Mohammed.
profit from hedging?
Yeah, but that profit from hedging will be offset by a loss in the underlying. The very fact of hedging means, like a Reliance, for example, I said, even the Reliance shares you are losing 1 lakh rupees, then you're hedging, you will gain 50,000 profit or 1 lakh, depending on how much you have hedged. But the overall net position will be zero.
Thank you, sir. Thank you so much.
Thanks. Thank you, everyone, for being a patient listener.
Apart from Tushar, sorry to interrupt. Apart from Tushar, there is no one who want to ask a question regarding mutual fund. It will help you in your NISM exam 5 way also. Any question, कोई भी क्वेश्चन जो एक छोटा सा सिली सा डाउट भी आपको लगता है जो आपका म्यूचुअल फंड में कवर नहीं हुआ है, we are having a expertise in mutual fund. तो यहाँ आप अपने पूरे डाउट क्लियर कर सकते हो. अजीत, भूपेंद्र, प्रतीक्षा, सुनीता, मोहम्मद, anyone?
No doubt, sir.
Okay,
No doubt, sir.
No doubt, sir, currently.
fine. No issue, sir. Thank you so much, Riyaz sir, for giving your precious time to us and sharing knowledge with our candidates, right? Thank you so much, sir.
And thank you everyone for being a
Thank you.
patient audience
Thank
and a
Thank you,
patient
Thank you, sir.
Thank you, sir.
you, sir.
Thank you, sir.
Yeah. Bye.
That was a
Good.
great
Thank you
Bye,
very much,
everyone.
sir. Bye.
Thank you so much, Riyaz. Thank you.